issuer pay, investor pay, or a public, let's say, support for rating agencies. All of these things were hotly debated. And this time round, the 10 years have passed in a relatively smooth manner, I would say. Is this due to ESMA? And of course, we will look forward to Verena giving us her vision of these last 10 years. But also, interestingly enough, the CRA doesn't have a revision clause on it. So tweaking happens through RTS. But is it due for a full revision? Do we need to focus on other things, bearing in mind, of course, we're in a very different geopolitical environment. We're in a different CMU. When we discuss the rating agencies, we're in full-fledged on responses to the crisis and the financial services action plan, looking at barriers to the internal market. This time around, we are trying to focus on building a capital markets union that is both open and protective of our way of life. So that is an interesting challenge for supervisors and regulators. And just to put you into the context of where we are now, we at CFA Institute, we did a global coronavirus survey where we looked at the impact of COVID on regulation, amongst other things. And there are two slides in that survey that I would recommend you take a look at. Because our members in the EU, who of course are finance professionals, really think that regulators and policymakers should be taking a very proactive role and looking forward to regulation rather than backward looking. And this, of course, is a big challenge. But that, again, is also, they favor a suspension of non-essential rulemaking. Meaning that this is quite clear. This should be focused, but also not tweaking existing legislation. So there is a thing of certainty of legislation, which is important. And then again, I think what was interesting, bearing in mind that most of our members are financial analysts, or at least on the buy side, 69% of our respondents believe that companies should be temporarily permitted to delay reporting on changes in their operations and or finance conditions. Now, this is something that I would like to get your feedback on to the three speakers later on. And lastly, before I give the floor to Rina, we did a survey on CMU in 2015, where we really saw that national insolvency rules are a very large barrier to investment. And I think, again, that is a key discussion we may have later on, how this could be changed. And again, we also very strongly believe that more direct supervisory power should have been granted to the three ESAs, and specifically to ESMA. Now, this is a success story for ESMA, direct supervision for 10 years. So I will now turn to Verena Ross, who, of course, doesn't need introducing, but it is such a pleasure to do so. You have been the executive director of the European Securities and Markets Authority, ESMA, for since 2011, since its inception. You were responsible for the organization, and you're part of the senior management. And of course, you are really very much a true European. You have also worked in the UK with the FCA and have had quite a lot of senior positions. So your experience both across the channel and on the continent has been very wide and experienced. And this, I think, in terms when we look at where credit rating agencies are, this should be an interesting way to look at it. Verena, you have the floor for 15 minutes. Thank you.
Thank you very much, Josina. And first of all, good morning, ladies and gentlemen. It's a pleasure to be here, and I want to thank the European Capital Markets Institute and Karel also personally for not only making CRAs and ratings the topic or one of the topics of this conference, but also obviously for inviting me to speak. Thank you, Josina, for the introduction. And I think indeed this is a very good time to talk about credit ratings and the role of CRAs, also in light of the COVID-19 crisis and the economic and financial impact of that, but also, as you say, the 10 years since putting in place the CRA regulation and supervision and ESMA's role in that. I will try to briefly reflect on the regulatory framework, also talk a bit about what the industry looks like now, and then get into some of the more forward-looking challenges that we see. Let me start with the regulatory framework. And as Josina already said, basically the first iteration of the CRA regulation in Europe was introduced in 2009. And that was obviously a time when we faced significant challenges dealing with the fallout of the financial crisis. At the same time, we were trying to rebuild, as regulators and supervisors, the framework for financial regulation more generally, making sure that financial stability and investor protection are put on a firmer footing. One of the areas that was identified at the time a need of regulatory oversight were credit rating agencies. And indeed, this was done really on both sides of the Atlantic, introducing minimum standards for CRAs and trying to rebuild the confidence into ratings in the financial system. In Europe, on top of that, spurred by the aftershocks of the financial debt crisis, the CRA regulation was revised in 2013 with some additional requirements in a number of areas, such as mechanistic reliance on credit ratings, which I think is still a topic very much in people's mind, and also specifically on sovereign ratings, given the sovereign crisis that we were facing. The CRA regulation was the first piece of financial legislation that provided for a single European level supervisor, something in my view entirely logical, given that credit ratings are issued by a CRA in one country and can then be used across the member states by investors. While there's always room for improvement in whatever regulation you look at, over the years we've taken the opportunity to flag some of those to the Commission, but I believe we can all agree that it was a big step forward in ensuring the quality and reliability of credit ratings in the EU. Looking now at the structure of the CRA industry in Europe, and I would be grateful if Beatrice can maybe bring up a slide here to show. As of today, we have 27 CRAs in the EU registered with ESMA, and they are basically located in a number of different countries. But as you can see, there is still quite a predominance of 3 of the globally active CRAs. Having said that, there are also a number of smaller CRAs that are either quite significant in particular asset classes or are quite dominant in a particular country. They overall, however, on a European scale, are clearly much smaller. So if you can take that slide away again. Thank you very much, Beatrice. Looking at the role of ESMA as the regulator of the CRA industry since 2011, we have built up, I believe, significant supervisory experience and expertise over that time, but Jan will be able to judge that as being at the receiving end of that. And I think what we've also been able to show is that supervision at the EU level can really work. We were, after all, the first of the European authorities that was given that responsibility, and it has since been widely recognized that that can work. Obviously, the most important next step was the SSM for the banking union, but also ESMA has been granted some additional supervisory mandates since the responsibilities for CRAs in the area of trade repositories, but also more recently in the area of securitization repositories, third country CCPs, data reporting, service providers and benchmarks are still to come. And so this is expanding in terms of a role of a European level supervisor. To ensure we carry out our mandate in an efficient and effective manner, we've adopted a risk-based approach to the supervision of CRAs. This allows us to prioritize our supervisory activity according to the level of risks that we identify and the outcomes that we need to achieve. To address the risks we identify, we have a number of different supervisory tools available to us, ranging from the normal day-to-day engagement with the CRAs to conducting investigation and requesting implementation of remedial action plans. Where breaches of the regulation are identified, ESMA has the power to adopt enforcement actions. These actions can range from issuance of a public notice to the imposition of a fine or even the withdrawal of the registration of a CRA. Where necessary, ESMA supplements these supervisory activities with the development of public guidance. For example, we have published recently a guidance to ensure that CRAs have strong internal controls in place to mitigate against conflicts of interest in their rating processes. You may have also seen our call for evidence on access and use of credit ratings. This is a topic that we know is important for investors and the market in general. Looking forward for 2021, the areas of our priority will be to look particularly at the risks posed from the implications of COVID-19, monitor that CRAs are ensuring the independence of their rating processes, and assess that their methodologies are robust, systematic, and continuous. In addition, we will engage with the CRAs to address concerns in the areas of IT and particularly information security controls. But I appreciate we're not really here today to talk about our supervisory toolkit, interesting as that may be, at least for me. So allow me quickly to address what we see as some challenges in the area of credit ratings and explain what we are doing to try to meet those challenges. I would like to focus here particularly on two. The first one is climate change. The European Green Deal is clearly a key priority for this Commission. From our vantage point at ESMA, there's still a lot of work ahead of us that we are sure to make the information points available to investors that they need to fully integrate ESG factors into their investment decision-making processes. In the area of CRAs, we have issued guidelines that aim to increase the transparency of the impact of ESG factors in credit rating actions. Beyond credit ratings, we are aware that CRAs are increasingly active in pure ESG ratings and the provision of ESG-related information. While this is not directly part of the scope of our responsibilities, our experience of supervising CRAs and credit ratings has put us in a good position to understand also the dynamics of these products and the industry, and in line with the expanded mandate that we have under the ESMA regulation when it comes to sustainability, and as part of our wider role as the European financial markets regulator, we take an active interest in sustainable finance issues. The second topic is, as I already said, COVID-19. The recent crisis has had a profound impact on our daily lives, all of us being sitting at home and doing this virtual panel, as much as we would have liked to visit Brussels. And so the credit agencies clearly need to take this impact also into account when they look at the impact on the economy, on the individual firms that they rate, as well as looking at the associated government support measures that have been put in place. For our part, we've been actively engaging with the credit rating agencies since the start of the crisis to ensure the continuity of their operations, that they were ensured and able to continue working effectively, and to understand, more importantly, how they were factoring the economic impact into their analysis. It is also clear that the wave of downgrades that followed the onset of the recent crisis have sparked a renewed debate on the role of and the reliance on credit ratings in the financial system. In fact, as highlighted earlier, the issue of over-reliance was a key element of the revised CRA regulation package in 2013. While there was some progress made in this area, most notably in ensuring that more recent financial regulation avoided mechanistic reliance on credit ratings, there's still a concern that key pieces of EU financial regulation and many private contracts, like investment fund documentation, contain references to credit ratings that could lead to a mechanistic reliance. This is something that is also being debated in the European level with the ESRB at the international level, and we are actively participating in that debate. So that's just a few words, and thank you very much for allowing me time for these introductory comments in order to describe the evolution of the CRA regulation and supervision in Europe, and I very much look forward to the discussion. Thank you.
Thank you so much, Verena. You've really given a very good revision of why the legislation came into being, what the historic context was, and what the current and future challenges are, which I look forward to discussing with all of us. Let me now turn to the two other speakers. With us today is Jan Lepalec, who is Executive Managing Director and Head of Global Rating Services for S&P. He's based in Paris and a member of the S&P Global Ratings Executive Committee. And I was very impressed by the amount of analysts you have underneath your guidance. So very welcome to that. But also you joined S&P already in 1999. So you have a long experience. You lived through the first crisis. You lived through to tell it. So I look forward to some of your memories of that period. So very welcome to you. And of course, now also we have with us Bo Becker, who is the Sevian Capital Professor of Finance with the Swedish House of Finance in the Stockholm School of Economics. You have researched on corporate finance. You've looked at corporate credit markets, bank lending, credit ratings, and restructuring. And I have very much enjoyed some of your research, which of course has been published in Vox EU. You have a master's degree from the Stockholm School of Economics. Forward to your comments specifically on some of the models, the issuer pay models, and the challenges that lie therein. But before turning to the panel discussion, could we have the poll up for the audience? The poll is on which policy areas are related to CRAs and require the most attention: issuers, sovereigns and corporates, users, investors and financial intermediaries, business models, supervision and enforcement, or ESG and sustainable finance. Please take your time to vote. I'll give you 1 minute or 2 minutes. And I hope we'll see the results soon on the screen. I hope you're all voting. Okay, do we have the results up on the screen soon?
69% voted. I can show it whenever you tell me.
Okay, could you show it? Great. So, interestingly enough, ESG sustainable finance is seen as the biggest challenge. This is interesting, and supervision and enforcement. So that points to both looking forward and the new world we live in, sustainable finance, but it also looks to the current context of the pandemic, which Verena highlighted on some of the issues in supervision. So with that, I'm now going to turn to my panel. And really the first question, and I would like to start perhaps with Jan on this. Has the direct supervisory model by ESMA worked so far from your perspective? Are there any issues in the CRA's regulation that should be looked at by regulators? Jan.
Thank you, Josina, and thank you very much for ECMI to be inviting us. Usually we talk a lot about our ratings because our role is to be as transparent as possible, to submit all our ratings to the broader scrutiny by market participants. But this time around, we really have the opportunity to talk about our experience as regulated entities for 10 years, as you said. Recognizing that this CRA regulation in Europe fits squarely within Capital Markets Union. As it was mentioned before by Verena, we are one of the few industries that are regulated at the pan-European level. And as a result, given the fact that our activity is really to provide, the borrowers with a passport to raise funds, we do that across the EU27. We actually do it as well to get for the borrowers in the EU27 to get funding from outside the European Union. But for us, being regulated across one coherent capital market is indeed very important, because it actually facilitates the flow of capital across those all those countries. The second reason why this is important for us is that, as I said before, capital markets union is an area that we've investigated quite a lot over the past 10 years, and where we believe that the European Union can continue to sustain, at this stage, the recovery from COVID by resolving some of the inherent issues of the current EU capital markets, which is its fragmentation. And again, ESMA's activities as a supervisor sit at the core of bringing all those capital markets together to make sure that over time there are additional channels of funding that are made available, in particular to European corporates, to get funding in addition to the traditional banking system, which again has a dual objective to support and facilitate raising funding, to fund investment and develop economic activity and job creation, but also reduces some element of risk in the system by European corporates overly relying on the banking sector. So going back to your question about the experience as a regulated entity, what we do is very simple. As I said, ratings are a passport for borrowers to get funding from investors. What is of utmost importance is that what we do is of the highest quality, that it's independent, and it's done with integrity. And certainly the whole regulatory framework in the EU is really there to make sure that all those three conditions are in place. Important factors are that the current regulation in the EU for CRAs is called CRA3. So it shows that it's already the iteration of two previous versions. And also, as Verena said, the way ESMA carries out its regulatory duties is not static. There are regular calls for evidence around regulatory technical standards where market feedback is solicited to then issue final regulatory standards. And a recent one was on ESG disclosure by credit rating agencies to be clearer and disclose to the market to which extent ESG risks have played a role in the rating decisions. When CRA3 was put in place 10 years ago, ESG was very much a widely talked subject, but it was not perceived as being that relevant. And there we've got an evidence that the current regulatory framework allows for flexibility to take into account market developments and adapt regulation if needed. So from our perspective, the regulatory experience is that, as I said, of a dynamic framework that evolves and adapts to economic and financial conditions. It is also a strict regulatory regime. The European CRA regulation, through the equivalence regime, has had a meaningful impact on other regulations around the world for credit rating agencies. And the way the supervision is carried out by ESMA was characterized at the beginning as intrusive. 10 years afterwards, what I can tell you is that it's a daily interaction. There's a constant wave of dialogues with ESMA on information requests, providing information, running interviews on thematic reviews and thematic inspections. And ESMA also monitors the execution of what we call management action plans, or the remediation of their findings in the various thematic reports. So when I said that this is a strict regulatory regime, its strictness is both in terms of the level of prescriptive of its prescriptiveness compared with other regulatory frameworks that like in the US, for instance. But it is also in the practice. Again, I insist, it's a daily practice. There's almost, daily interactions, questions, and I would actually characterize the supervision as it's a real effective challenge on all aspects of what we do. What is core to ESMA's mission is to make sure fundamentally that we follow our policies, procedures, and ratings methodologies. And that is really what is happening almost every day, as I mentioned before.
Thank you, Jan. Hearing you, very little is wrong with the regulation, and nothing but almost compliments for ESMA. So I'm going to turn to Bo. Bo, what is your impression? Has the direct supervision by ESMA worked? Are there any issues in the CRA regulation that we should be looking at? And maybe from your perspective of some of the research you did into the business models, maybe you could highlight whether there could be some tweaking on this. Thank you. The floor is yours.
Thank you first for having me at this very interesting conference. And on this distinguished panel, I'm honored. It seems to me that credit ratings are incredibly important for the big project of having a capital markets union, and therefore it's an appropriate subject matter. It's also a time when we expect a lot of insolvency in the near future. That also makes it topical because credit ratings are a warning system for that at the macroeconomic level. And I think ESG is huge, and the rating agencies may have a role in that. May I show us a quick slide, Josina?
Yes, of course. You can share your screen. Thanks.
Okay, here we go. So I was speaking about the topics that we expected to come up today with Carol. And one of the things he thought we should talk about is whether credit ratings are better than before the global financial crisis. And so let me give you the academic view of this. Also, another question is ESMA effective, or more provocatively, is it ineffective? And then what's the role of ESG ratings going forward? So are they better than before the global financial crisis? I would say that they are slightly better than before the financial crisis. You only know how good ratings are when there's a big recession and you find out if things were optimistic beforehand. Clearly, there were mistakes with structured securities that were revealed in 2008. I don't think those mistakes are likely to happen again. But structured securities are particularly problematic. And I saw in one of the Q&As someone mentioning CLOs, and I think where the rubber is going to hit the road in 2021 is in CLOs. That's a structured security that consists of loans, that's backed by loans. Those are difficult to rate, and we'll see what happens in the next year, I think. Why did ratings improve? I think there was a loss of reputation that the rating agencies responded to. There were some legal penalties, settlements in the US notably, that cost some of the rating agencies a lot of money. And I think there was a learning that happened. Note that the oligopoly remains. There's not that much competition, and we saw that in the official or in the ESMA statistics. However, this to me is not a first order policy concern. The fact that rating agencies are profitable is one reason why they care so much about staying in business and being viewed positively. And this is a motivation for accuracy. So just the thought experiment of a completely competitive ratings environment where there's hundreds of rating agencies that carry the same weight in financial markets, then all issuers would always be rated AAA, I think. So we want competition, but we don't want too much. And so I guess that's how I come to the question of whether ESMA is effective. I think the answer is not really effective if the goal is higher competition. And that's what the data shows too. There's still three agencies that do most of the business. I don't think that should be the question asked of ESMA. So, oh, wrong order. Okay. I also think that the micromanagement that Jan is kind of complimentary about, I think that's useless at kind of a big picture kind of way. I don't think it helps very much with the average quality of the financial system across the European Union. However, I think ESMA is effective in terms of producing a level playing field across the European Union, producing better transparency, and so on. And I think that long-term task, I think ESMA is very effective and can do more, or can be even more impactful. But I think that's an essential task. I think on the narrow question of, do we have more competition? No, ESMA has not been effective and cannot be effective. I also think that, on a kind of personal note, speaking for my private interests here, I think the data for research on European credit ratings performance and the engagement with academics, I think there's some upside here that could be very beneficial for everybody. Okay, finally, quickly on the ESG ratings. Of course, this is the next frontier. There's so many questions from investors about what is the sustainability impact of my investment decisions. That requires some form of rating. These ratings are not credit ratings, but there are many similarities. And there are many prospective raters. They're popping up everywhere, including zealots and charlatans. What I mean by that is, institutions that are on a vendetta or with a very kind of specific agenda, and some that maybe don't have the highest standards. And so I think actually it's worth considering the idea, which I guess Ms. Ross is also discussing, which is credit rating agencies might be a good place for ESG ratings to take place because they have more to lose. They have the potential to lose their credit rating business if they do something bad with ESG ratings. And this is an incentive to perform that new raters lack. The question is, can they learn the science and so on? That's the big question. If ESG ratings can ever work, I'm not competent to assess that.
Thank you very much, Bo. I think I would like to dig a little bit deeper now, and maybe turn to Verena for next, and sort of bringing together some strands of thought that came out from both Jan and Bo, and that is really, we have these challenges. ESG is a real new challenge in terms of information and possibilities of greenwashing. We have, of course, the products such as CLOs, which, when we look at the indebtedness we're facing in the EU, but globally, I would say the real challenge to bring the right information for the investor. What about, though, the model itself, the issue of pay? Now, we've gone round with discussions, and it was highly attacked back in the last crisis. Bo, some of your research highlighted that there might be some issues in terms of leniency by credit rating agencies where there are, let's say, other monetary fees, etc., for consultancy. How can we avoid this discussion? Is really, investor pays is difficult, and it's not going to work. There've also been discussions back, probably Verena, you remember it, in the Parliament, about creating a public European credit rating agency as sort of as helping in that debate. We are always struggling to find that transparency and that, let's say, protecting the end investor, making sure that the information getting to him is enabling him to take those decisions. Now, in COVID times, this is really crucial. Verena, maybe your thoughts on this.
Thank you, Josina, and I'm very interested in the comments made by Bo and Jan, but you put it all together in one question. I'm not quite sure I can cover everything in a short answer.
Don't worry.
Let me try. So maybe on, first of all, and starting with your last point, I think the core of this is clearly ensuring that the investors have the right information about companies, about investments they want to make, and the ratings are clearly a way of giving investors that information. For that, not only do the ratings need to be of high quality, properly designed and everything else, but they also need to be delivered in a way that doesn't create conflicts, where basically an issuer starts negotiating with the CRA. If you just give me a bit of a lower fee, you know, I will kind of get a better rating, or the other way around. So this is, I think, where the issue is when it comes to issuer ratings, issuers paying for ratings. And that is one of the areas that the CRA regulation and our supervision is clearly focusing on, is that conflict of interest, and making sure that there's a proper divide between the people who are on the analyst side and not being influenced by the commercial side of the activity. So that is very important. It is a focus point for us to also maintain the quality of the ratings. The investor pays is a very nice idea, but I think, as you rightly say, we've seen it hasn't really worked, and there have been one or two CRAs that have tried it, but it's a very difficult model to make work. So I think, from my perspective, the key here is that investors have the right access to the rating data, and that is one of the areas that I said we were looking into a bit further, which is about availability of the rating information, and that investors can then choose how much to rely on that or not in their investment decisions. I think on CLOs, we did actually publish in May this year a report on CLO credit ratings specifically, and we tried, in a way, what it showed was that there clearly has been some experience learned from the financial crisis that has flown into improvements when you look at how CLOs are rated. At the same time, we also identified a number of issues that present risks and made some recommendations. Amongst those, the fact that there is the need for the CRAs to be really able to quickly and timely identify new risks and incorporate them into the ratings. The model and third-party dependencies can lead to some operational risks, and also the need to continue monitoring market trends in this market. And here again, there's also the risk, as in all ratings, of a commercial influence. So I think those are the kind of topics that we particularly identified in this CLO report. And finally, on ESG, I personally think this is core to making sure that we have, again, common information and transparency to the end investors of how to compare apples, pears, and oranges. Currently, there are many different ways of rating ESG factors globally, and there are clearly international movements underway to try to create some more consistency there. The European Commission will look at some of this, has already looked at it in the taxonomy regulation, the disclosure regulation. We are working on some of that implementation, but there's also more to do very clearly to ensure that firms provide the right information for investors to make choices on an informed basis. Thank you.
Thank you, Verena. Very complete. I realized that I threw a very large question at you, but I sort of saw it all encompassed in a whole. I would like to turn to Jan. What is your perspective on this?
So on the issuer pay model, I mean, there are different ways, as was mentioned before, to operate as a credit rating agency: issuer pay, investor pay, or public utility. All of them have conflicts of interest. What is the most important is that any credit rating agency that opts for one of those business models is able to identify, manage, and disclose its conflicts of interest. Regarding the issuer pay model, this is what we do, and this is what the regulation does, especially in Europe, to make sure that we do exactly that. This is what I called making sure that we follow our policies, procedures, and methodologies. They include an entire internal control framework that we attest every year, and that is really the core of our risk management system that gives this assurance that when conflicts exist, in case of the issuer pay model, what was said, the rating shopping, so basically a higher rating for a lower fee, that these risks are identified, managed, and very importantly disclosed by the company. On the benefit of the issuer pay model, from our perspective, it's the one that allows entities to make their ratings freely available to everyone. In the case of an investor pay operating model, no investor who pays for a particular rating will accept to disclose it freely for the other investors. If the entity that is rated pays, then once that rating is attributed, and the company makes the decision to release it, then it is released to everyone. That's the biggest advantage. Another related advantage is that by doing that, immediately all ratings are subject to the broadest scrutiny. And this is where I cannot insist enough on the important role of investors and the interaction that our analysts have with them. At S&P Global Ratings, we view the interaction with investors as part and parcel of our quality assurance process. While some of them may have a skin in the game and biased views, by being able to explain and expose our ratings the way they are constructed, expose them to criticisms, is for us the best way to make sure that not only beyond our own internal processes and procedures, once the rating has been delivered by the credit rating committee according to the application of methodologies, following certain processes, it does not end with the release of the rating to the public. I would actually argue that this is when the dialogue begins with the broadest community of investors possible, who've all got different points of views and reference and opinions. But it is by achieving that level of scrutiny from the market that we can continue to improve the quality, the relevance, and the integrity of our ratings. So that is really, I think, the strength of the issuer pay model. So linking this to the question on CLOs, beyond the ratings, if we want to submit them to the broader scrutiny, in addition to releasing our ratings, we need to publish research that complements those ratings and help investors understand. For instance, in a world of uncertainty like where we are, particularly in Europe, in the second wave of the pandemic, the level of uncertainty is such that it becomes very difficult for everyone to be making assumptions. So in other words, it is very difficult, given the importance and the relevance of downside scenarios in particular. It is very difficult to give one direction, which is what we try to do, but what becomes important is to giving to the investors what we call scenario sensitivity analysis that can give them a view if a downside materializes, really, and a certain set of different scenario materialize, what can they expect of us from our rating decisions? So in the space of CLOs, we've done that. It's not the only one, but we believe that in addition to making sure that we stay on top of the surveillance of existing CLOs, we have to provide additional information to the investors that allow them to understand the impact of certain stress scenarios on our CLO portfolio. And we try to do that regularly. By the way, the issue of CLOs is not new, but COVID is a catalyst in terms of what was already in the economy, in the financial system. And we've been publishing for 2 years along a theme that is called When the Credit Cycle Turns. Because already 2 years ago, we were at the end of the most benign credit cycle in modern history. And the likelihood of the credit cycle turning was becoming, higher and higher. And there was a series of themes that obviously, depending on the magnitude of the economic downturn, certain asset classes that would certainly attract a lot more scrutiny and questions. And one of them was CLOs. You also have the theme of fallen angels, that is companies, large companies in most cases, rated BBB, which is the cusp of what we call investment grade range, that were running the risk of, through an economic shock, becoming downgraded into non-investment grade category, which is quite important because usually, statistically speaking, when you go back at ratings behavior between an investment grade company and what we call a high yield company, the speed to default and the volatility of a rating is much higher in the high yield space than what it is in the investment grade. And that's actually a very important definition of our ratings, is that the higher you are, the more stable your rating is expected to be. And the more lower rated, the more volatile your rating is meant to be, even under minor economic shocks. And CLOs, which are structured transactions, the underlying assets are loans to corporates, usually smaller sized corporates, and of a lower credit quality. The whole technique of structured finance is there to provide protections to investors who buy those products, but obviously an underlying economic driver of those CLOs is the financial health of the loans that are used as collateral in a transaction. And so what we are doing for CLOs, which is to apply our methodologies, surveillance, particularly on the quality of the underlying pool of collaterals, which are loans, that then most of them we rate, and we assign what we call a recovery rating, which is a very important variable in the determination of the quality of the CLO. In addition to doing all of this, given the size of the uncertainties, we also provide additional information that allows investors to understand how we may react under certain scenarios. So I really want to insist on the point that, and that's been the case at S&P Global since the 23rd of January, when we decided to create a specific web page on our public website to publish any COVID-related rating actions, research pieces, was exactly to do that, to provide to investors all the transparency that they need at a time of uncertainty. At a time of uncertainty, it's not by providing less information that you make the situation better. It is to provide more information. It doesn't mean that in certain areas, as I said, we do not have any certainty, but it is to try and communicate about what we believe are the alternative scenarios that exist. The last point on ESG, our focus for the time being is what we call ESG in credit ratings. We know from investors that they want more information. They want to understand better how we take into account ESG risks in our credit ratings. And this is what we're working on as we speak. Bo raised the question of ESG competence of our analysts, which is a very legitimate one. ESG is the area where we are investing the most in terms of resourcing and training our own analysts. The degree of overlap between ESG risks and credit risk is actually significant. If you take the governance risk, it's almost 100%. For social and environment, it differs by sector. There are some sectors where, for instance, environmental exposure is credit relevant, others where it is not. But for those where it is credit relevant, we need to deepen our understanding. And even more importantly, as I said before, be clearer and more transparent about to which degree and how we take those risks into account. And for us, I would say it's not a brave new world, because I think that in governance over the years, we've built up a strong expertise. But for the environmental and the social risks, this is happening as we speak. And for the foreseeable future, it will remain for us a key area of investment.
Thank you, Jan. You raised the key issue and you went into quite a lot of detail, which I thank you for, on sort of how you are achieving this transparency also in times of COVID. At CFA Institute, we do almost yearly trust surveys when we look at what institutional investors are expecting and what retail investors are expecting. And this key for institutional investors is to get really the right information in time and to be as forward-looking as possible. Bo, when I turn to you, I mentioned your research into the issue pay model, but also looking at, the underlying issues in the crisis with instruments like CLOs, and then looking at the additional challenges of ESG disclosures. Where do you think we are, and what are some more attention points?
That was a broad question also. On investor pay, let me talk about that really briefly. I think there was a lot of interest after the global financial crisis in exploring alternative business models. And I think basically the experience is that is difficult to make work. I agree, they all have conflicts of interest. I think you could imagine certain ways of making the conflicts of interest smaller for credit rating agencies, such as limiting the amount of business they can have with the rated entities outside of ratings, consulting. Seems like an obvious, potential source of additional incentives that are contrary to ratings quality, and that we don't need. When I say need, and we, I mean society doesn't seem to have. There's some benefits for S&P, potentially for the clients if they have additional consulting business, or Moody's, and same for all the rating agencies. But maybe, we could do without that in order to reduce the risk of conflicts. There's the micromanagement issue, which I think is ESMA was asked to intervene in the production of credit ratings in a way, or was given the authority to intervene in a way that I think is not solving any problem relating to these conflicts of interest, and therefore it's unlikely to help. Mostly based on first principles and the absence of evidence for any particular improvements in the ratings that ESMA has authority over. I could be wrong, but it just doesn't seem like that's solving the real problem. And then finally, of course, the ex post penalty for making a mistake is that your reputation suffers. And I think that's where the global financial crisis actually did improve things a little bit. And for that, things like ESMA helping provide transparency around performance is essential. And I think that these are the tools we have. And just to round that discussion out, we have a century of experience of credit ratings. They have failed once or twice, and it's been pretty serious, but the overall record is good. Now, most of the overall record is about corporate ratings, and I think that's where credit ratings shine. And the structured area is much more murky. And so when we think about ESG ratings, I think we should keep that in mind, that this works well sometimes. It doesn't always work well. And there are certain circumstances when third-party ratings really can help make life easier and the processes smoother in the financial sector. But there are also some settings where maybe it's just everybody has to do their work on their own.
Thank you, Bo. That pointed quite lightly. And Verena, I am going to give the floor to you for reacting to.
No, I just wanted to come back because I didn't have a chance to say it earlier. So I think we need to be clear also what responsibility ESMA was given, and clearly the competition remit is not in our remit. So I think we need to be clear about that. That might have been an intention in some people's mind when they drafted the legislation, but in effect, we don't actually have any powers to look at competition issues. What we have the power to do is, on an annual basis, publish the type of statistics which I showed earlier, and then people can draw their own conclusions. Then you can, maybe at some point there is a decision that should change and the competition should look different, but that's not something that we have a direct influence over. I think where we do have an influence and where I would want to disagree with Bo is the conflict of interest point, where yes, we don't involve ourselves in the business model of the CRA itself, but ensuring that if there is an issuer pay model or an investor pay model for that matter, that there are no conflicts that are impacting on the quality and the fairness of the ratings and transparency of the ratings. That is something that we do focus on, and we've actually taken a number of enforcement cases on this type of issue. And so this is something which is at the forefront of our regulation. I think coming finally to the transparency again, for me, that is one of the key issues, because it's clear that ratings are so important for the wider market and for the investor community at large. And there have been complaints about the cost of actually getting access to some of this information. And that is an area, as I said, that we are actively investigating, which is not directly linked to competition, but is about the transparency of the rating, which is one of the responsibilities that we have.
Thank you. Thank you for that complement of information. I think that was quite good to reframe that debate. Verena, yes, Jan.
Yeah, I'd like to make quick clarifications based on what Bo said. We don't do consulting. I've got to be very clear about that. We don't do consulting. That would be absolutely impossible. ESMA would see to it, but from from a business model perspective, that's important. And then on top of that, you've got a series of regulatory dispositions and our internal policies, and then as one is called non-structuring. So I think it's a great example of the fact that we don't do consulting. One of the great values of our ratings, as I said, it's their independence, their integrity. And the second point is on the independence. Our relationship with ESMA is on how we follow our policies, procedures, and methodologies. It's not about the substance of what we do. So in other words, there are analytical independence, that is to say our rating decisions and the way we decide to structure our methodologies, that independence is actually enshrined in the CRA regulation. So when I described our relationship with ESMA, I don't want to give the impression that it is about the substance itself. It is everything around, but at the end of the day, our opinions and that independence of those opinions is what is the most important. So again, if we were to do consulting, that very independence would be immediately threatened. So we don't do that.
Thank you for that, Jan. Bo, would you like to respond very quickly, because I see we are at the end of our time. So maybe in 1 minute, if you want to respond to both, Verena.
Thank you both for setting me straight about the scope of your business and the scope of your regulatory remit. I think that's
okay.
important.
I would like to give the last closing comments to Verena. Verena, the next 10 years, what do you think is going to be necessary to tweak on CRA regulation?
I think it's difficult to tell exactly, because to be fair, we are still in the middle of the COVID crisis. How this will exemplify itself and play through the whole cycle of also ratings and so on, I think it's still difficult to tell. For me, I think the key issue over the next 5 years at least, let's be trying to focus on the more medium-term future, is the whole question of how to build the capital markets union in Europe. And for that, I think we need the whole kind of ecosystem of financial markets to be strengthened in Europe. And that starts from the companies themselves and access to the capital market, where clearly ratings have a role to play. I think SMEs in particular are finding it very difficult and very expensive to get ratings. And that is one of the aspects that clearly, together with a lot of other things, to be fair, is an issue about how to ensure that they have access to capital outside of the pure bank loans that they are so reliant on still in Europe. And I think from the other side of the Capital Markets Union and the investor perspective, we really need to build trust of investors in being willing and able to invest in capital markets. And that is clearly something that it needs to a lot of our attention over the next 5 or 10 years.
Thank you so much. Thank you so much to my speakers. You have really highlighted some of the challenges, some of the good points, some of the tweaks that are necessary. Trust is mentioned, transparency. But what is interesting to me in this debate, if we'd had this 10 years ago, it would have been a very negative debate. And what I feel very much is that we are in a very positive, constructive mood to construct CMU in spite of being in a green swan pandemic crisis. I thank you very much to all three of you. Thank you.
Thanks.
Thank you very much.
Thank you all, and we will reconvene at 12 with the next session on easing financing conditions for corporates.